All right. Welcome to AHA with Amplify. I'm just going to let everybody log on. And while we're waiting for everyone to get on board, I'm going to cover a couple of admin items. So we're really excited to let you know about Let's Lively Entrepreneurial Talks with Amplify. So this is our latest and greatest attempt at getting into the 2023 century where video is much more popular and audio than reading. So we've decided to join the modern forces and provide some of our thought leadership in the form of video and shorts and podcasts. So please be sure to check us out. It's Let's Lively Entrepreneurial Talks, and it's myself and my co-entrepreneur, Jesse Ferguson, and we're talking about things that matter to you, business leaders in our community. So the first episode was cash flow, and we talk about all the different things companies can do to get a handle on their cash flow challenges. And we talk about how cash flow is a common challenge with growth, and whether or not you're struggling or in distress or super successful and selling more than you could even imagine, you're going to certainly struggle with cash flow, but it's manageable, and we provide a lot of tips and tricks to help business leaders manage their cash flow. Just dropped this morning is our second episode, which is on talent. So we discuss everything in regards to talent. And obviously, as a growing business, we're constantly hiring, and we do solve people problems. So both our recruiting department and our finance leader department, which is fractional CFOs, fractional controllers, and accounting services, is constantly helping teams build finance and accounting and help with their talent. So we're always in the know when it comes to talent, both as executives within clients and as recruiters assisting clients. So please be sure to download and listen to our talent episode, which is now available in podcast or video or shorts as well. So that just dropped this morning. Next, coming with AHA with Amplify, our webinar and event series that you're here joining us for today, we are going to have April 18th, business liability exposures and risk management tips. So as business leaders, and many of you are also finance leaders, we certainly know that insurance and risk mitigation and knowing where our exposures when it comes to liabilities is a critical part of our job and one of the most expensive buying decisions we make each and every year. And insurance has changed drastically since the pandemic, and so that has complicated those decisions. So want everybody to get what they need so they can make those decisions wisely. And I hope that you'll join us on April 18th for our noon webinar to discuss that important topic. In May, we're inviting Amplify Tech, our internal team, to talk to you about ERPs and cloud systems. So excited to have our own internal team talk about the important conversations that are happening in tech today. So we'll be doing that on May 16th. And then the third Tuesday of June, we're actually going to talk about personal branding. I had an opportunity to write an article in the CPA Dividends magazine, and you can find that article as well as the more amplified version of the original article on our blog. And that article had me introduced to a lot of people who are really, really keen on the topic of personal branding. We're keen on it because we know that for candidates to get the jobs they want and have the careers they expect, that personal branding is a huge component, and that's what made us passionate about the topic. And we're going to have an expert talk to us for our last episode of the series in June. So personal branding is June's topic. Amplify Tech comes to talk to us about technology in May. The next one in April is business liability exposures and risk management tips. And without further ado, today is private business structuring and estate planning. Really excited that I had a chance to meet Rick Varney at an alumni event and found out that he's serving some of our CFOs and some of our clients, and that we have obviously a lot in common, coming from a similar background at PwC. And I don't have anything in common when it comes to tax and structuring knowledge. So I will be sitting here as the most active participant of all. Funny enough, I told Jesse he better attend because I'm going to have a follow-up conversation with him, because it's a little bit of shoemaker's kid, but there's times when I'm not sure that we structured Amplify right off the bat. Of course, when we incorporated in May of 2018, It was exciting, it was scary, it was a big gamble, and the last thing we were worried about was the structured incorporation. We just wanted to find out if we could even pull this thing off. Turns out we've pulled it off and we structured it wrong. So we are in the shoes of many of the business leaders, and I know that many of you finance leaders are supporting business owners in this area. So lots to learn. I'm sure we can't possibly cover it all, but at minimum, it's going to pose some questions and pose some ideas where you might want to call Rick after, or you might want to call your tax advisor or your lawyer or what have you, to make sure that you're not making decisions today that impact your tax or your structuring or your valuation. So without further ado, thank you for joining us, Rick. And don't forget, if you do have questions, please type them out and I'll be sure to incorporate them in the conversation with Rick. So happy to answer questions through, so be sure to type them as you have them. Thanks, everyone.
Thank you, Jamie, and thank you, everyone. I did get the opportunity to see the names of the people, or at least that were registered yesterday. Some of them were familiar, so hello to those that I've met before, and looking forward to meet you all on a more non-virtual basis as your needs arise. As Jamie mentioned, I did spend a good chunk of my professional career with PwC. I practiced as a tax specialist, focused in the private area for more than 25 years. I spent the last 2 years, I'll call it my COVID years, with a boutique insurance firm where I got the opportunity to do something else, but also learned that I'm better at using the insurance tools rather than selling the insurance tools. And so I got the opportunity and to go back to my first love of being a tax practitioner and doing that on my own shingle, so to speak. So bringing all that experience to you today, I want to give you the opportunity to do a high-level overview of some items that I believe are critical to a private business. I'm going to try and stay away from numbers. I actually don't have a single number in the slide, but I do have pictures in the hopes that pictures will say 1,000 words as opposed to just me talking incessantly. And as you can see, the quote from Jamie, again, she's mentioned it, you got to think about your structuring up front because you could have unfortunate things to deal with down the road. So let's get going. So as I think you'll learn in April, as part of my, call it risk mitigation, I'm going to put up the slide that I've done my best to tell you everything and gather information that's free of omissions and errors. But this isn't tax advice. This is just information. And I would strongly encourage any of you that are inspired by any of the comments to reach out to your tax advisor, or if you want to give me a call or an email, happy to connect with you, because every person's tax situation being a little bit different can change the tax focus items. So just be wary of that. And again, before we get into the details, I just want to highlight 3 things and 3 messages that I want to get that I think will resonate through the next 45 minutes or so of our talking time. And again, we'll take questions throughout. First, Jamie alluded to it. You need to be prepared to live with the future consequences arising from your current decisions. And with the pressures of today, again, the last thing someone may be thinking about is how might my decisions on structuring impact a sale down the road. Needless to say that if you give a little bit of conscious effort up front, you can help yourself. Of course, you can't plan for everything. There's uncertainties. And so what I've learned, the best way to deal with uncertainty is to keep your planning flexible. If it's flexible, it gives you more options down the road to deal with those unintended items that pop up into your business or even in your ownership group. And lastly, again, a lot of these things do require professional assistance, even if you deal with it on a regular basis. And even though professional assistance may be considered expensive, in my experience, if things go wrong, fees will be more than what you may have intended up front. But worse off, you might actually have tax consequences arising from poor structuring choices. So at this point, remember number 1, choose wisely up front to help yourself down the road. So let's take a look at the agenda. I'm just going to cover off a few things, basic structuring options, kind of go through, the things that you've seen before and just highlight a few items. And then I'm going to talk a little bit more and probably a little bit more in depth about the use of a family trust. In my experience, people think about a family trust after I've accumulated a bunch of wealth in my business and it's really part of my end of life planning or my estate planning. I'm here to tell you and try to dispel that myth that the use of a trust can be a very flexible tool in running your business and assisting with a lot of the items along the way. And of course, one of the things that are going to happen is that exit. You know, I'm going to sell my business, pass it on to my kids, pass it on to management. And then, of course, there's that final exit, the terminal tax planning, where the two items always come to roost: death and taxes. And what tax guy can't help himself, but at least to try and talk about a few items that may be coming up at the end of the month. Keeping my ear to the rumor mill, I'll highlight a few items to keep your eye out for that may impact private business, and then we'll wrap it up. Structuring options. Like even Jamie's situation, they were out front, they wanted to get their business going. So most businesses actually just start up by an individual, starting to do what they know and do best, and it be an unincorporated business. Of course, that's usually, it can be long-lived, but in most situations is short-lived, and the next common structure would be that of a corporation. And again, in Jamie's words, they quickly incorporated the company and got things going, and there's nothing wrong with that. The one thing I will say, though, as a rule of thumb, it's much easier to get assets into a company on a tax-deferred basis than it is to get them out. So something to think about is, do I need to put my asset into a corporation today in the event that I might need to get it out down the road? But even when you're starting up a business on your own idea, you might actually have value in your hands. And when you incorporate, you actually may want to talk to a tax professional as to whether I need to enter into an agreement with that new company to transfer my early stage business into that company on a tax deferred basis. Again, I'm not going to go into those details, nor am I going to go into the reasons of should I incorporate, not incorporate, but suffice to say, that's probably the two most common items that you're going to see in any business structure. The last one I'm going to highlight, of course, is a partnership structure, whether it's a general partnership or more commonly a limited partnership structure. Again, I think partnerships are a great flexible tool in the right business situation. I mostly see them in real estate type ventures or professional service organizations. With the limited partnership structure, you can still get some benefits of limited liability protection. Some of the tax rules around dealing with a limited partnership can be sticky. And in a general partnership, I see those less because of the unlimited liability that attaches to it. Of course, I'm not a lawyer, and in any structuring decision, you should seek legal advice. But what about this structure? It's got a couple boxes. It's got a family trust. I'm going to submit to you that this is a structure that provides flexibility. And how is that flexibility going to be achieved? I'm going to come back to that because I think I need to prove my case a little bit more before I start throwing a bunch of arrows around in a structure that might not be as common to some of you, and some of you it may not be. It may be common, but we'll just do a good reminder. So a few top of mind items when I'm helping or working with clients. Two things I see that, again, I think need more attention sooner rather than later. The first is unanimous shareholders agreement, or I'll even say partnership agreement. But really in the corporate context, unanimous shareholders agreement, you need to prepare it when relations are good. Why? Because when you're going to be using it is when relations are typically not so good. And if you have an agreement that dictates how events are going to happen when you're maybe not getting along so well with your partners, it adds an ability to manage your structure and maybe add a degree of flexibility. I'll even say that in closely held corporations amongst the family, I've seen unanimous shareholders agreement work as well, because unfortunately, we may not get along with other family members as long as we would like. So again, even if you're in a business with a non-family or with family, I think you should think about a unanimous shareholders agreement. Now, what are the items that a unanimous shareholders agreement cover? It's many items, but I typically like to summarize that it's usually dealing with the departure of a business partner. On a voluntary basis, they may do something else, or you might actually take out your partner and use the provisions of unanimous shareholders agreement to assist in that process. Or there's the involuntary ones. Unfortunately, a business partner passes away. And you have to think to yourself, I'd like doing business with my partner, but do I want to do business with my partner's estate or his family or his spouse? If you don't, you'd like to have an agreement that helps you get out of that situation. And of course, a matter that can help in the life cycle of a business is a way to value your business in the absence of an actual third-party transaction. Talking about those transactions, the minute book. Lawyers are pretty good at keeping it up to date. I've seen some clients that maintain it themselves, and that can be done, but you need to maintain it. You need to keep it up to date with share certificates, resolutions, annual filings of the annual return with Alberta registries, because if you don't do that on a timely basis, you may inadvertently dissolve yourself. And again, one thing that I've seen is where the minute book gets looked at is right before they're going to be sold. As part of the due diligence process, the minute book's a mess. And I've seen situations where a proposed purchaser sees how messy the minute book is, and they start to think about what else is a mess in the business. And that can impact not only the relationship, but the ultimate business transaction itself. So let's get back to that family trust. And again, I'm just going to talk about the sooner rather than later, and I'll make that point a little bit later. So again, I'm not going to go through all facets of a family trust, but I think I want to talk about the establishment or the settlement of the trust and the key people involved. And the reason I want to focus there is I think that is where is most important to get it right. And if you get it right at the beginning, it'll help you managing the trust through its life, in particular managing tax issues. So who are the key people involved in a trust? Well, there's a settlor, there's trustees and beneficiaries. Again, I'm going to go on the assumption that most of you are aware, but who's the settlor? Somebody I would say who has a connection with, I'll say, the family, genuinely wants to bestow a gift and take care of, or at least give something special to the family. So it's not just your lawyer. And if there's any lawyers in the crowd, no offense, but I think there has to be a genuine connection that the settlor wants to bestow a gift. It doesn't necessarily have to be the grandmother or a relative, but a close business partner. It can be a good settlor. Of course, the trustees are the ones that take the property from the settlor and manage it on behalf of the beneficiaries, i.e. they control the destiny and investment decisions of the trust. And of course, I would say the more important piece are the beneficiaries, typically family members, more recently, immediate family members. I've seen trusts that include extended family like Uncle Bob, Auntie Jessie, Grandma Mitchell, but those are less common and really because of the trust reporting rules that I'm going to touch on briefly. Another important beneficiary, I think, is a corporation. I think that adds a tremendous amount of flexibility in managing the structure, your business structure, as the business and the value in your business grows. Of course, those corporations are not any corporation. It's really a corporation either controlled by the trust itself or family members. Then I'm going to call there's these other beneficiaries, maybe in the contingent category. I mentioned charitable organizations and trustees that I've been involved with. In the event of a catastrophic event where all living beneficiaries are no longer with us, what do you do with the trust fund? Well, a contingent beneficiary might be a charitable organization. Other aspects I've seen is that the terms of the private business owner's will would dictate. So there's options there. Other trusts, they're common. I just put a question mark because of, I'm going to say, recent attention by tax authorities in terms of planning that may be available to avoid. There's a tax rule called the 21-year deemed disposition rule. And there's planning that you can do for that. And I'm going to talk a little bit about that. But let's just say the tax authorities, CRA in particular, might be a little fidgety around having trusts as beneficiaries. And I'm not going to expand any more on that point. So getting back to a point that I did talk about in terms of how wide a group of beneficiaries do you want? There are new trust reporting rules. Some of you may be familiar that they were in play. They were actually intended to be effective for 2022 tax year ends this last December, but last fall they extended it again. And I'm pretty sure that there's going to be no longer any extensions and that there's expanded reporting. And it's basically the reporting is around the tax authorities want to know more information about who was involved in the trust. And really, it's who were those three categories above. Who's the settlor, who are the trustees, who are the beneficiaries. The form, in draft that was provided, I haven't seen a final form yet, but basically the tax authorities want to know who the names are of all those people, what are their birth dates, what's their tax ID number, their social insurance number, or if they happen to be out of country, perhaps their taxpayer identification number for US taxpayers. What country of residence are they in? So again, it's information based, but as we know, the tax authority isn't asking for this information for no reason. I'm not going to theorize what I think they're going to be getting at, but let's just say the more information they have about your structure, the more opportunity they have to look for soft spots in your structure. And the key point I want to mention today is Non-compliance can be very costly. One of the penalties can be as high as 5% of the highest value of the trust fund. So if your trust fund has a couple $1,000 in a bank account, well, maybe that's not that big. But if it's shares of a private company that has grown in value, 5% of the shares of a private company can be very significant for failing to file a form. So again, if you haven't heard about these, reach out to your tax professional. Notwithstanding, the first filing deadline is for the end of this year. Some of this information may take some time, and you may have to think about if you even want to keep your trust around. And again, some of those older trusts that I have experienced that named extended family members like Uncle Bob, Auntie Jessie, they may not even know they're part of a trust. But now you got to go and ask for their social insurance number. They may ask questions, and then you may just not want to ask those questions. So again, have a good discussion with your tax advisor around that. Again, settling a trust is important. And when settling a trust, there is an item, again, I'm not a lawyer, but I've been around these things long enough that I can speak in generic language about them. And these three certainties have to be met to have a properly settled trust. If you don't have a properly settled trust, all the benefits that you're endeavoring to obtain can be lost if a tax authority comes to the conclusion that you didn't settle it properly. So what's that first certainty? There's a certainty of intention. There was a clear intention that the settlor intended to establish a trust. And I'll just say that the importance of a trust deed and a well-worded trust deed and working with legal counsel to make sure that's done. The second certainty is certainty of property. There was clear property that the settlor owned. They had to own it. And they bestowed it as almost like a gift. My go-to settlement property is a combination of typically a precious coin and cash. And again, those are held by the trustees. And again, clearly the settlement property is clearly defined. And it was a clear gift without any consideration being given back to the settlor. Third is, of course, who are the beneficiaries? And again, the trustee needs to clearly identify the beneficiaries by name or class. So name's easy, my son John, my daughter Amanda, or grandchildren, great-grandchildren, but the classes can be as well. So if you're perhaps a younger business owner and you don't yet have grandchildren, you can still name a class of beneficiaries to be grandchildren. You can also include children, whether born or adopted. Again, as long as they're clearly defined, and of course that all-important corporation. And again, properly drafted trust deed and making sure the process is well adhered to is important. In the lawyers and accountants that I deal with, imagine an accountant and a lawyer calling me anal. So in this situation, I am actually quite anal when it comes to being very diligent on this process, because I want to ensure that trust issues will not result, and they will result if you have a poorly settled trust. Why do we want to go through all this? Well, it's really in a general description. It gives the trustees, and I will go so far as to say the private business owner, to manage the family wealth over time. Sure, there's the management of funds for minors, but they now have the ability for trustees to manage the allocation of investments or manage the assets as time changes. So when you start your business and I'll say your family trust, you may have children, but you're not going to know which child may or may not take an interest in the business. So now you can take information, I'm going to say over the first 20 or so years, to see which children are going to do what. Which children might have issues, whether that be mental or otherwise. It's unfortunate, but I've seen it happen. Marital issues, so there might be some hesitancy to put value in your children's hand if their marriage isn't going well. So again, trustees can now have the ability to take all that information in before we have to make a decision to see what assets go to whom. Now there is this, again, there's some legal court cases. I'm not a lawyer, but I did get the benefit of attending a Miller Thompson presentation in the last month or so. So I thought I'd thank them. And as well, just mention that, there is this concept of even-handedness that, each beneficiary needs to be treated under what the terms of the trust confer. So again, the lesson there was a clearly drafted trust agreement. And then what about a beneficiary who, again, it's a discretionary trust, but is going to try and lay claim? For instance, maybe a spouse that is no longer your spouse because of a divorce. Might the court be able to intervene and say, well, no, you can't really cut this person out of properly out of the trust deed. There's this concept called malefides, which I'm just going to generally say that the trustees basically were acting in an unreasonable manner, or they perhaps were considering factors that were irrelevant. Suffice to say, I think the discretionary family trust does have a good level of degree of unfettered decision making by the trustees, but there are limits. You just got to be careful with that. And the trustees don't have to do it all by themselves. They can retain investment managers, help professionals to manage the assets. And at the end of the day, when you do have assets to give to beneficiaries, you don't have to incur a tax liability in a properly structured and managed trust, because those can be rolled out of the trust into the hands of beneficiaries without any tax cost, depending on the fact situation. Though again, there are some exceptions, but usually those deal with non-residents. And I'm just going to leave that comment there. And lastly, asset protection. Yes, there is a level of asset protection, but I'm going to say that it's really I think a friendly lawyer would tell you that a family trust will provide an additional hurdle as opposed to an absolute guarantee and shield. And again, depending on the province you're in, you may have different things to consider. But ultimately, you may need to even protect the beneficiaries from themselves. And again, I have in mind one client that it was an adult beneficiary that had some challenging mental issues, and the trustees were getting a little bit aged. So they involved a professional trust company with a bank, and now they were able to manage the funds going into the hands of this adult beneficiary. And again, it adds flexibility. So again, trusts provide operational flexibility. What about those tax matters? Well, I'm going to quickly go over these and then we'll take some questions. But really, the common item that is thought about of a family trust is it helps in managing my ending liability. And it does. One of the primary things you want to do to manage your terminal tax liability is to manage the amount of value that is in your hands at death. And a family trust can, properly implemented, allow the growth of the business to actually go to the trust and not a taxpayer's estate. But the private business owner can still control the trust through voting shares or other means. Historically, there was a lot more income splitting opportunity in a trust structure. Those were neutered by the change in legislation that was announced in around 2017 and then implemented in 2019. Tax on split income, or you might have heard your accountant refer to the acronym of TOSI. However, that coveted lifetime capital gains exemption can still be extended to immediate family members, so multiplying that tax benefit. And there still is income splitting opportunities. And that's kind of where corporate beneficiaries come in. One, it allows an ability to carve cash out of your operating business. I'm going to talk a little bit about that in a few minutes. But you don't have to incur a personal tax liability to get that cash out of the business. And once you've gotten that cash out of the business, that's where you can get some income splitting opportunities. And I mentioned it before, there is a rule in the Tax Act that every 21 years, there is a deemed disposition. Now, there is a misconception that a trust only lives for 21 years. Well, that's not true. In the trusts that I've been involved with, it's usually the life of the trust will end 21 years after the death of the last living survivor at the settlement date. So if you had a 5-year-old grandchild and they live a fruitful life, the trust can live for 100 years. But for tax purposes, every 21 years, you got to deal with the assets. And if properly managed and structured trust can allow you to manage for that ultimate tax event. So there, family trusts do add flexibility. So Jamie, before I continue going, I've been a talking head for a few minutes. Are there any questions that want to be addressed?
Yes, sorry. A couple questions. In proper settlement, you emphasized how key it is to have proper settlement. What would examples be of an improper settlement where clients have gotten themselves into trouble?
The primary trouble that I've seen is CRA has, when they're auditing, they will ask trustees, please show me your settlement property. excuse me? Well, here it is. It's the photocopy of the $10 bill in the back of the trust settlement agreement. No. I need to see the $10 bill. Well, I don't have that $10 bill. If you can't prove the settlement property, you've got a problem. So that's one of the reasons why I typically like to at least have a precious coin. And it doesn't have to be the gold wafer or the silver dollar. I actually had a client a little while ago, it was settled with a 25-cent silver piece. So it was a collectible coin. It was worth $80, but the trustees are not going to put that in an envelope. It's going to be attached to the trust deed, and it's going to actually be available to show a tax authority if they ask for it. The other items that I've seen problems with is, I don't want to get into this ugly area of attribution, but there's a few things. The settlor has to be one to, I'm giving this gift without any consideration. And so you can typically document that well, but you don't want to be giving your settlor, hey, thanks for settling the trust, here's $100. That's going to be bad. And it's going to taint the trust, and you're potentially going to lose a lot of the benefits. I'll leave it at those two. There's other iterations.
So hypothetically, if last week I was told to get a settlor to send $22 to my lawyer, that was for this?
It could have been. It very well could have been. And I would like to think that he didn't or she didn't e-transfer the money, but they actually gave the 2 physical dollar bills. And to be honest, my typical thing is my go-to is a precious coin and 3 $10 bills. Usually at least 2 of the $10 bills are going to be needed to get the corporations in place, and one $10 bill is going to be sitting in the envelope with that coin, and it's going to be sitting there in the hands of the trustees until the trust is no longer needed.
Okay. Interesting. I will have to ask you more questions offline.
Fair enough.
Awesome. Okay, and then I don't know if you're planning on going into it a bit deeper already, but the capital gains exemption, are you planning on talking about that more? If not, can we just revisit that a bit?
I am going to be talking about that coveted tax benefit, yes.
Yeah, because I think that, from a practical and realistic perspective, most clients that we work with, ultimately the effort that they put forward towards restructuring and double checking their structuring is ultimately driven by that particular tax rule. Yeah. And obviously there's some things that have happened in the last 5 or 7 years or what have you that have overcomplicated it and made life a little bit tougher for those rich entrepreneurs that I think I read an article that an average entrepreneur makes $70,000 a year. So better hurt them with tax.
Yeah. Well, I definitely am going to focus a little bit of time on that tax-free money.
Okay, awesome. I'll let you go for it. Thanks.
All right. Thanks, Jamie. And in that vein, we're going to be planning for the exit. So how do entrepreneurs exit their business? The most common one is we're going to sell to somebody, and I've even say going public. Most of my comments are going to be more around the sale perspective, but they can apply to both scenarios. So when do we start planning for the business? 6 months, 1 year, 2 years? I would submit to you that the successful, and I would even use the word serial entrepreneur, usually will think about selling their business when they're setting it up. Because how you set up your business can make things either easier or more difficult down the road. There's always going to be a due diligence process by a purchaser. Again, you see that minute book pop back up. Make sure it's up to date. Make sure that the people you say that own shares actually own shares. The certificates are in place. Of course, there's corporate items to deal with. Are all your tax returns filed? Have you properly documented your issues? If you've got cross-border operations, transfer pricing policies are typically a hot topic. If you're in the US, have you looked at all the places that you do business? Are you filing tax returns in all the proper places? Again, things that you don't want to think about 6 months before you sell, but you're actually constantly thinking about doing good governance. Also, those key customer contracts that are driving your business, quality of earnings, again, that EBITDA calculation that I referred to, which is a common item that is looked at when valuing a business. And of course, when I'm selling my business, what am I selling? I can either sell assets of the business or I can sell shares. I'm not going to get into that distinction as to why you might want to sell one or the other. But what I will say is if you don't pay attention to your structuring, you may be limited on what you can sell. And as soon as you limit your flexibility, ultimately you're going to be disappointed, potentially with a higher tax cost. So let's keep that going. One other item I actually wanted to come back to on the quality of earnings and EBITDA. The other thing I think you need to be careful of, because I know I've seen it in private business, is how much personal lifestyle do I put through my business? I.e., I'm always on business. I'm always doing business. And that trip to Italy, I was looking at real estate, so it's a business expense. You can defend that to a tax authority if you want, but you have to remember, if you put a $10,000 family vacation in your books, when you apply a 5, 10, or 15 times multiple, okay, 15 may be excessive, but let's say a 5 to 8 times multiple, you've now decreased the value of your business by that vacation by 5 to 8 times. So just remember, managing your expenses is also going to be managing what your future value could be. The lifetime capital gains exemption. So yes, as Jamie mentioned, it's typically an item that business owners and entrepreneurs want to take advantage of. That limit increased, and now that exemption is tied to the cost of inflation. So every year it's going up, and as you can see, it went up quite a bit in 2023. Gee, I wonder why. In any event, it's approaching $1 million. So when you take a look at an Alberta resident taxpayer and you look at the highest marginal rate of 24%, the tax value or the cash value of that exemption on a per individual basis is, it's over $250,000. And probably if inflation continues as it is, we're going to be over $1 million pretty quick. And farmers are already at $1 million. I won't elaborate there, but theirs was locked in at $1 million a few years ago. So what about this family member? Well, let's say you have a family of 4. So you got the 2 parents, a teenager, and an elementary student, and the family business is worth $4 million and the shares are sold. Well, if you're able to structure it properly, you're going to put almost $1 million in your pocket than if you didn't have proper structuring. So again, it's certainly valuable. So how do you get at a capital gains exemption? Well, I just need to own shares of a private business. That's true, but there's more to it. Not to get too tax jargony on you, but you need to have qualified small business corporation share. Well, what's that? Well, it's a QSBC share. Okay, well, what's that? Well, there's really 2 tests that have to be met: a holding period test and an asset test. And I'm going to call it an in Canada asset test. So first, if you don't pass test 1, i.e. if I haven't held my shares or operated my business for more than 2 years, and Jamie, looks like you've crossed a 2-year hurdle from the incorporation date that you spoke of a little while ago, you've crossed test 1. Now you need to be careful that if you do reorganize your business, you have to do it properly so that you don't lose that 2-year period test. So again, talk to your friendly tax advisor if you have to restructure after you've incorporated. And so the asset test, there are 2. The first test is you look at that same 2 years, and generally it's interpreted that more than approximately 50% of your value of the business is attributed to active business assets. So again, 2 years, 50% of the business assets are in an active business, and that includes goodwill. So don't forget that. And at the time of the sale, so right before I sell, that level goes up to 90%. So that's where you might need to do a little bit more planning that Jamie referred to if you didn't manage your cash well, and you may have to do some expensive purification is the buzzword. So I'm going to go over 2 problems that I commonly see. If you want to call excess cash a problem, it can be if you want to get your $1 million of family capital gains exemption money, and also foreign operations. Suffice to say, poor structuring choices may eliminate or neuter the use of your capital gains exemption on a share sale. Simple structure, and I would be surprised if there isn't a good number of you that run your business have this. You got the operating company, lawyer told you, and maybe even your tax accountant told you to incorporate a holding company. Well, why? You can move excess cash out of the business, and adds a level of creditor protection. You can do your estate planning at that holding company level, so you don't have to bother your partners. And of course, as that cash builds in that holding company, you might have an investment portfolio. You might actually invest in other private businesses. So maybe you're a minority shareholder in some other private businesses. And if you've gotten some poor advice, you might actually have the family boat in the holding company. Yes, I've seen that. But what happens when you come to a sale? you got a problem. One, chances are that you'll meet the 50% test with excess cash. It's unlikely that private business owner is going to have more than 50% of passive cash. But what about other things? What if you have another private investment that's taken off? Well, you may not be able to move that out very easily. And if you do move it, maybe you have a very lucrative investment portfolio. Well, you may have to remove all those assets out of your holding company because it's these shares that have to be sold, because it's the private business owner that's going to claim that lifetime capital gains exemption. So if you can't clean up or purify this company, you're not going to be able to use your capital gains exemption. And because this won't be a qualified small business share. Or if you did so, the cost of purification, i.e. the tax cost, might be more than the $200,000 that you're going to save, assuming you only have one exemption to use in this scenario. So, okay, we'll just sell the shares of the OpCo. Well, boom, you're out. The lifetime capital gains exemption is only claimable by the business owner, not a corporation. So in this scenario, if you can't make this company clean before a sale, you're probably not going to get the coveted lifetime capital gains exemption. So what about this structure? Well, we can have a private business owner. You know what? I don't need a holding company because all my excess cash is going to be plowed back into my business. I'm going to expand. I'm going to grow across borders, whether that's in the US or Europe or other areas. And if those foreign operations become successful, and let's just say that the foreign operations grow to being more than half of the value of OpCo, you got a problem. Why you got a problem? Well, that first asset test is an in-Canada asset test. This business is arguably outside of Canada. So if more than 50% of the value of OpCo is outside of Canada, you're never going to meet that first 2-year holding asset test. And if you can't meet that test, you'll never meet the 90% test. And those shares, I'm going to say, will never qualify because it would be prohibitive to likely extract these assets. But even if you extract them, you'd have to hold them outside of your business structure for 2 years. Now, there are ways, if you're not entertaining a sale, to clean up this structure and separate it. And we can do those things. But as Jamie alluded to, because of the decision that was made to put the foreign operation underneath the operating company, when that foreign company has value, you're going to have to incur additional fees to clean it up. So what structure can help us here? Let me go back to the structure that I showed you a few minutes ago. What I've done, though, is I've now added in a pillar under the family trust that the foreign company is going to actually be a sister company to the operating company as opposed to a parent subsidiary. And you'll see why that's important. So what are some of the situations that this structure can help? Well, let's talk about excess cash. The operating company, and I'm going to focus on the Canadian one, is generating excess cash. We got to get that out of the business because we don't need it. We're going to move it up into the holding corporation because that's who owns the shares. But as I just told you, this may not be the best resting place for that cash. So we're going to take it out of the holding company as well. So we're going to pay it up to the family trust. Well, you don't want to stop there because if you paid that dividend up to the family trust, you probably, and you don't do anything else, you're probably going to trigger a tax liability on that dividend at a personal rate. And I would say arguably the highest marginal rate, regardless of whether it's in the trust or any of the beneficiaries. But what if, of course, one of the beneficiaries is that wholly owned corporation of the trust? You know what? The trust is going to allocate, or the trustees is going to allocate that dividend over to that wholly owned corporate beneficiary. What I like to say is that bank co now is holding a straw, and the trust becomes that perfect straw, and it sucks all the cash, and that cash is out of the business. It's not sitting in the holding company. So these shares remain clean. And now this cash is away from the business, and this company can do whatever it wants. It can invest in marketable securities, can invest it in other businesses. It's no longer, it can even invest it back in the business if it wanted to. But needless to say, you've got flexibility. You've got choices. So again, one of the reasons that trust cash comes out, or excuse me, the excess cash comes out, holdco is purified. Again, it's clean and easier to manage that coveted qualified small business corporation status. So let's get back to that foreign structure that we put up as a pillar. So of course, the Canadian business remains in OpCo, foreign co, and then I'll say there may be more than one. Maybe you'll have a US pillar. Maybe you'll have an international pillar. But needless to say, you're going to have value in your foreign operations that is not in the Canadian pillar. What does that mean? The holding company shares have Canadian value. The foreign hold company has foreign value or non-Canadian value. So when it comes to sell, those shares of the holding company are very likely or much greater chance of being qualified. And now you can multiply up the exemptions for any value attributable to that family trust. And as many individual family members that have that qualified small business corporation and large corporation, lifetime capital gains exemption, there could be some very good savings. Alternative minimum tax might be a factor to consider, but we're not going to go into any level of detail there. What I will say is I consider an AMT or an alternative minimum tax payable is really to be a tax installment. With proper planning, you can actually use that prepayment of tax. All in all, I'd say the structure seems pretty flexible. So we now talked a little bit about selling to a third party, and I'm going to stop there, Jamie, just to ask if there's any questions before I move on.
Yes, a couple questions. I mean, the most obvious one is that straw looked like it was plastic.
I know, I tried to find a paper straw. I apologize. It's a non-Calgary straw. How's that?
Oh my goodness, illegal behaviors.
Yes. I do apologize for that. My pictures were limited.
I love it. It's all right. Okay, question then. You mentioned the lifestyle expenses and decision making, and I just wanted to touch on that quickly because it does relate to structuring to some degree. And you made the comment about a $10,000 Italy trip and how that could impact valuation because you are suggesting that it's a business expense, and obviously the buyer is going to push hard that, well, wait a minute, it's a business expense. It's a business expense. Yes. Now, obviously, any good valuator and any good valuation is going to have a little bit of back and forth in terms of normalization.
Correct.
Obviously, when it comes to expenses, I can see why a buyer would have the advantage of pushing and pushing, given that you claimed it as an expense and included in your up P&L. But so I get where you're going with that for sure. But what about when it comes to actually compensating the founders and the business owners? That one's a bit more tricky because I don't know of any valuation that wouldn't start with just pulling out all founders and owners comp and then bringing a market value in. So with that in mind, I always say it's really not a huge factor because almost every valuation is going to pull it out and then put a market value in anyways. So, but maybe I'm being too simple and black and white about it, but want to hear your perspective on that.
I don't disagree with anything you just said, but what you have done is you have to track it. You have to make sure you pull it out, and you have to make sure you don't lose sight of it. So I always find it's easier to track something if it's not there to have to worry about. And I'm not, there are genuine business expenses. So tax items aside, I think, what I think you're referring to is a normalized calculation. And certainly, you normally wouldn't pay a whole bunch of bonuses to a manager who isn't an owner. So that is the experience that a chartered business valuator can bring to the process. So yes, but the important thing is to also remember to track these things so that if you do kind of get to the idea of, I got to normalize my my earnings, you need to know the abnormal expenses to normalize it.
Perfect. Yeah, that makes sense. And similarly, if you're underpaying yourself or overpaying yourself, track it and then have a point of view on what a market value should have been.
Agreed.
Yeah, for sure. Foreign operations, what dollar value or level of activity would push a person to think about adding that extra column to the structure? I mean, obviously, you have one client or one little toe in the water in the US. I wouldn't think you want to start two more corporations.
Yeah.
But what's that breaking point where it's worth thinking about and worth considering?
I think I'd start off by saying no one wakes up in the morning and they're in a different country that they weren't into. It's a process, it's a timeline. So for number one, you need to have good communication and governance standards between your, I'll say, sales force or your business people and the finance people. Let them know what you're doing, where you're going. And so the first place is information. it's tough to give a dollar value. But if all I'm doing is delivering goods or delivering services into a foreign country, and I don't have a physical presence in that country, it's probably not something that's going to dictate setting up a separate structure, because arguably you don't have a nexus or a presence. But as soon as you start thinking about, oh, I'm going to need to get a salesperson, I need to move, I need to move assets into that jurisdiction, I think it's really more an activity-based item than a dollar value item. And you need to take a look at your business plan. Are you just, you know what, I'm going to this trade show? Well, fine. But if it's something that you've started to negotiate contracts, you're actually got a proven concept and a business plan, ensure they are structuring alternatives are part of that business plan.
Awesome. I have a couple other questions, but I have a sneaking feeling you're going to touch on them anyway. So let's get back at it, and then I'll ask them after.
All right. So I've talked about disposing of the business to a third party. Well, you know what? It's a family business. We might keep it in the family. So how can a family trust help there? Well, I talked a little bit about earlier that, and I'm just going to say in that first 21 years, and let's say the first 20, I'm going to get an opportunity to find out which children are actually going to want to be part of the business. And so now, once I identify the children or child that might take over that business, I'm able to actually tax effectively get shares of that business into the children's hand. But of course, you love your children. You're not going to treat them unequally in most situations. So I'd say that the family trust does add flexibility to do that estate equalization. And again, it's a detailed discussion, but suffice to say that there is flexibility added by using a trust structure to handle children that are involved in the business and those children that may not be. I'm also going to mention the intergenerational transfer legislation. And some of you, of course, may be aware that the government introduced legislation back in the summer of 21. And I'm just going to say it's imperfect, but it was intended to allow a family member to sell on a commercial basis to another family member and actually claim my capital gains exemption, as I would if I sold to a third party. Prior to 2021, you couldn't. There was rules that basically recharacterized what otherwise would be a capital gain into a deemed dividend. So the legislation attempted to correct that. The government quickly came out and said, you know what, it's not perfect, we're going to fix it. The problem with an imperfect legislation, or as a tax advisor, the benefit of imperfect legislation is it did create loopholes, and it allowed for a situation that I could extract capital out of my business on a tax-free basis. So for those of you that haven't done that, I'm going to say you probably have a week to get that done, because the rumors are, as the rumors have been, I'll talk a little bit more what might be happening on the federal budget in a few minutes. Of course, we could also pass the business over to management. So the first question you got to ask yourself, do I want my employees to be shareholders in my business? Or do I just want to incentivize those employees to grow the value in the business? Depending on the answer to that question will depend on your structuring alternatives. Stock options are ways that you're going to incentivize and eventually have your employees to be shareholders. There's phantom equity participation, and that means that they don't really have shares, but they can participate in the value. Again, may not be as tax advantageous, but nonetheless, you can get the right activities from your employees without actually giving them ownership. And then, of course, there is actually bringing them in as being shareholders today, but those employees may not have the money to acquire shares in the company. And so there's a freezing process. The last one I'm going to mention is that there are entities in the mix and in the discussion. And I've got the trust of the question mark. There may be the federal budget talking about structures that may allow on a more efficient basis to have employees participate in the business, but a trust will be a shareholder that the employees are beneficiaries of, and therefore they're not actual shareholders. And that kind of comes back to the trust discussion that we had a few minutes ago. So we've talked about setting up your business, the structures available. We've talked about using a family trust as possibly adding flexibility. We now have talked about, how do we sell our business? Well, then there is, of course, that final sale. Yes, the terminal tax planning. I've alluded to it before. Really, what terminal tax planning is limiting the amount of value in the private business owner's hands at their time of death. That typically involves an estate freeze and then potentially reducing that value over time through a wasting freeze, i.e. redeeming shares over time. But on the other factor, you also need to consider insurance planning. Like I said, I was with a boutique firm for 2 years. I'm not going to turn this into an insurance presentation, but insurance is a valuable tool to manage that liability because without a proper way to manage that liability, you can cripple your business with the passing of a significant owner, and if there isn't insurance in place. So I'll only talk a little bit about that. So again, very generic business freeze. What does it look like? Private business owner running a successful business, owns all the shares, comes to a point in time that, you know what, I want to actually introduce employees, or I want to just freeze my tax liability. Well, we'll introduce a structure and some actual additional professional fees, as Jamie would refer to. And essentially what happens is the private business owner's value is fixed in preferred shares, and all the future growth after that point in time will go to a family trust. And again, that family trust will have non-voting or limited value shares. And of course, this picture looks somewhat similar to the flexible structure that I alluded to before. So yes, if you're not in that flexible structure, you can get into that flexible structure. I had a mentor that told me, if you don't have a family trust in your business structure today, the next best time to introduce it is tomorrow. So think about it, reach out to your tax advisor. So again, ultimately, there probably is going to be value in the hands of that key person, that business owner. And I borrowed a slide from one of my insurance friends, basically outlining, look, you have 4 ways you're going to pay that final tax liability. 1, you're going to sell the asset that you hold. So the blue line, again, in this scenario, I think it was a little over 300,000 of terminal tax liability. So what? You got to sell assets worth 500, incur the tax in the orange, which then would reduce the cash available close to what you need. Or you can just go out and borrow that money, or the estate would go out and borrow that money. Well, of course, if the estate goes and borrows money, it's got to repay it with after-tax dollars. So again, we got to earn more than that liability, and there's insurance costs. You can save. So as long as you don't die too soon and you have enough time to save money, you can actually save and have the money be invested and end up with the money you need to pay those taxes. But of course, as the bar graph shows, one of the more cheaper ways to plan for that ultimate liability is to use insurance. I'm not going to go into any more detail, but if you haven't talked to your tax advisor about how can insurance be a tool to be used in my business and estate planning, have that discussion. I'm happy to chip in if need be.
So just to clarify, this tax liability is like at death.
Correct.
Okay.
Correct. It's kind of like it all comes in because at death, the tax rules deem you to have disposed of all your assets at fair market value. So if the private business owner is holding valuable private company shares, that liability is crystallized, even though the cash to pay that liability may be in inventory and goodwill.
Right.
So we're almost there. The federal budget. Any burning questions before I get here, Nick, Jamie?
Yeah, a couple of quick questions. So taking this a bit personal, I'm totally abusing you.
No problem.
But I
No
believe
problem.
that my questions are relevant to the business owners that are here and the finance leaders that help them. So our lawyer has said something along the lines of like, you need to make these decisions a good 4 years before any possible sale. Now, Jesse and I are 10 years out, though he kept procrastinating on signing the engagement letter. And I felt like he was trying to lock in our relationship longer and longer, which was very sweet of him. But what is this 4 years? Like, what's the magic of 4 years? Is that the number that you would advise to? Again, it's not super relevant for us because we're a good 10 years from leaving Amplify, but it seems like a number that's critical. And you, next thing you know, 10 years becomes 4 years.
Well, I'm going to assume one of the underlying items is that the lawyer knows that you're going to want your capital gains exemption. You have to hold the shares for 2 years.
Okay.
You don't need to hold it for 4, but you're also going to want an amount of time for that business to grow. And so if you make the decision to implement a family trust, again, the benefit of a family trust and the multiplying of those capital gains exemption is only if value accretes to the shares owned by the trust. So if you haven't implemented a family trust, you're going to have to take all the value that you own today, and it's only future value. So you're going to need some time for that future value to accrue to those trust shares. The other thing is once you start thinking about the process, it'll guide your daily decisions. It'll probably change the way you govern your business. You'll be your minute book, your contracts. You'll start thinking about, what homework do I do today so it's not all left for tomorrow when I got to put together the due diligence binder. And so I think it's just you need a timeline to get those things correct and to get the value increase in the right areas.
So I guess it comes down to what you've repeated more than once, and that is, revisit the structuring now is the best time. And if you don't have a family trust, the sooner the better.
Yeah, and again, everybody's fact situation is different. But I like to think my favorite client is who I call the serial entrepreneur. I'm actually working with one client that he's at his rodeo for the third time. He didn't have a family trust for the first one. He set it up for the second one, and he's coveting all the benefits on his third time. But what has he done? He's learned from each one of his transactions, and he's gotten better at structuring his business every time he's come back to the rodeo.
Nice. Another thing that I see commonly, and I mean, as CFO, it can be the bane of our existence. But we see it oftentimes, and it can be driven by many reasons, but there is many structures which have an operating company split into numerous legal entities. And I mean, we've seen that for true liability purposes that have nothing to do with tax, but the actual dangers and risks within the operations can drive that decision. There can be decisions to split the operating company because of a future sale and the way that shares are most likely to be purchased and what the M&A trends or expectations are. And of course, tax can drive it. So just want to touch a bit on, what types of things would you consider when advising a client if, most companies start with just one operating company and,
Yep.
Happy to have any department that's working. But at some point when they're reconsidering whether or not to split departments into legal entities, what are the things that you would consider from a structuring perspective?
The first thing I think about is what kind of business is it? Is there a valuable intellectual property that is inherently driving the business? And so I think guiltily, again, back to this one client who's in the downhole tool drilling business, and their business and the technology of their tool is wrapped into intellectual property. We have the ownership of that property in a separate entity. One, liability. Two, the people that are driving the value of that business and the value of that IP are different than the people driving the value of the business of selling. And so by having different pillars, shall we say, we can actually reward employees differently. If there's manufacturing operations, typically manufacturing may be wanting to be held differently. If there's real estate involved in the business, most businesses, you don't need to own your real estate, you can rent it. But if you own it, that might be a retirement asset. So I would say it may be best to have that real estate investment outside of the business, because when you sell your business, you might become a landlord because the people buying your business may not want to buy the land and building. But if it's in a separate entity and they want to buy it, well, they can always buy it. But if they don't want it, you can become a landlord. And so much easier to have land and building outside of an operating company than to try and get it out. Because if in that situation, all of a sudden it's too expensive to get the real estate out, I've got to sell the assets of the business. And oh, by the way, I just lost out on my capital gains exemption. So there are a lot of decisions that you try and think about what are the core business assets, want to keep them together. And are there the different lines of business? Like you might end up selling, if there's different lines of business, you might have someone who wants to buy one line and not the others. Well, if they're all in one legal entity, again, you're back to having to sell assets and not shares. So you have to think a little bit about, is there a prospective buyer for this line of service, but not everything? And then that might dictate you to want to set up different corporate pillars for the different lines of business. Again, it comes back to, I can always put Humpty back together again. It's very easy to take a bunch of corporations and amalgamate them and sell them all together. But if they're all together, very difficult to break them up if somebody only wants one piece. There are rules in the Tax Act that inhibit you from doing that effectively.
And so from a practical perspective, obviously you've got the hassle of the entities for the accounting department, but having said that, a good ERP, a good team, and
Yes.
you're probably slicing and dicing by division and by region, et cetera, anyways.
Right.
So that is arguably not a deterrent. And then, of course, there's the compliance of your annual returns, both your tax and your corporate returns, et cetera. So those are obviously a bit of a deterrent, but what I hear you saying is there is a big driver in terms of, splitting things up
Yeah.
is difficult from the Tax Act. Putting things together is not at all.
And I'll, not to get into all the fact situations, but if you do have multiple lines of service and you don't want a whole bunch of different corporate entities, a limited partnership structure might be an area where you can divide up your business, but not really create a whole bunch of separate you're going to have separate partnerships, but I think generally it's easier to manage the life of a partnership than it is a separate corporate entity. So I would just mention, in some situations, partnerships might help you manage your multiple lines of business.
Awesome. All right. So what's the budget have in store for us?
All right. Let's start with the obvious. We got a week. If your tax advisor isn't working on one of your transactions, they're probably working on somebody else's to get it all signed, sealed, and delivered before next Tuesday. And before next Tuesday means Monday. And if you are engaged in a tax sensitive transaction, and that can be varied, you never know. I'm going to give a list of items which any one of them or none of them are going to be seen a week from now. And there might be stuff that we weren't expecting show up. And so the best defense to not have an unexpected tax consequence is to close a transaction, whether it's a sale of your business or extracting money out of your business. Intergenerational transfers. I mentioned this before. There was that faulty legislation that was brought in the summer of 21. Initially, the government said, hey, we're going to fix it by December 2021. And then they called a budget, or excuse me, they called an election. And then they go, no, we're going to have, we're going to fix it in 2022. And then they had the budget and they go, we're going to have a consultation paper. And everybody expected that the fix was going to come out before Christmas. And that didn't happen. Well, we now have what I'm going to refer to as a pre-election budget. Are they going to fix it? Are they not? There's been a lot of signals they've been working on it. So it would be a surprise to me if they actually don't do something more than say that they're working on it. I mentioned in the same bullet point, capital gain inclusion rate versus anti-avoidance legislation. And so for those that have been part of the rumors, there is planning to extract capital out of private companies and to recharacterize that into being a capital gain instead of a dividend. And because the tax rate on dividends is so much less compared to tax rate on a dividend, certain political parties would just say, well, let's just increase the capital gain inclusion rate. Let's make it 75%. Done. Yeah, I would agree that would work, but you're probably also chasing capital out of Canada because typically foreigners don't like taxes on capital. So they might be able to just introduce legislation that will limit some of these evil transactions in the eyes of the government. And the buzzword is a capital gain strip for those that are into buzzwords. But ultimately, I would be, again, equally surprised that if they introduce the fix, that they don't also introduce something to address capital gain stripping. The more employee ownership trust, again, that question of I want to involve management in my company, but I really don't want to make them shareholders, but they might become shareholders. Well, details haven't been released, but maybe an employee ownership trust might be a solution. So if that's something you're struggling with and you see this a week from now, you might want to ask your tax advisor about it to see if it's something that'll help you. Like any entrepreneurial organization, you've probably got some innovation in your business. SR&ED, Scientific Research and Experimental Development Program. In a nutshell, that is a government program to help the creation of intellectual property in Canada, but there really is no government incentives to help commercialize that technology. And that's really what a patent box regime is intended to do, is to give incentives on commercialization that exists in other countries that may or may not be something that a private business would be interested in. But typically, innovation starts when businesses aren't public entities. So there may be some people in the crowd that would be interested in that. And unfortunately, yes, there's more talk about penalizing those nasty entrepreneurs that are working in Canada, busily creating employment for Canadians. Maybe that's my inside voice that's talking. But in any event, there's been noise around a new tax. There is an alternative minimum tax in the system currently that basically will potentially apply if you take too many tax benefits in 1 year, i.e. claiming capital gains exemption or getting a very high dividend in your income. Jury's out as to what it's going to look like. Some people have said it might be an asset-based test. So maybe there'll be a new tax on those very wealthy entrepreneurs. And what's very wealthy, who knows? But maybe if their net equity is in excess of 20 million, maybe there'll be a new tax for them. Including comments. Of course, I'm going to show you my picture. I think this, I've made the case that this is a flexible structure. You can defer cash that's in the operating company and use that perfect straw, a paper straw, to get that money into your investment company. Now this company is going to be kept pure. When we sell, we can use the multiple capital gains exemption of the individual family members, and killing two birds with one stone. We've now limited the value in the private business owner's hands. So on passing, we will have a lower terminal tax liability. But also in the family that's going to run the business, instead of selling, you can now get these shares into family members' hands on a tax efficient basis. And where unforeseen items, either from creditors of operating company or maybe matrimonial disputes, a level of protection can be assisted by the family trust. But again, you got to seek some legal advice on that. My three messages: be prepared to live with your decisions of today, tomorrow. Put some thought into it. We're not saying that you have to spend a bunch of time, but if you think a little bit about how you plan on monetizing your business, and again, when you're in the excitement of growing a business, but again, most businesses might have a little bit of value, but once you've got a proven concept and that value is starting to take off, maybe you need to do a small estate freeze and implement that flexible structure. Because again, flexibility is the best way I find in dealing with items that you don't know. And ultimately, yes, you're going to have to seek professional advice, but in more likely than not, if you lost out on one capital gains exemption, I don't think you're going to spend $250,000 on professional advice to set it up. If you want to, give me a call. I'll happily, for a cost of $250,000, but I guarantee you, as a rule of thumb, I'm going to say you could probably get that structure set up in a simple business in less than 30 grand. And I'll leave it at that. Questions? Awesome.
So if you were a finance leader or a business leader within a business and the founders and the entrepreneurs were relying on you, what's the first thing you would take a look at or question or challenge to help them with their structuring?
Well, the first thing I would look at is the minute book and see if it says what you think it says, who the shareholders are, to be honest with you. I would really want to know. Start with the homework. Do we have good clarity on our facts? Once you have your facts clarified, they typically will take care of themselves. And so the next thing I would take a look at is simply look at the balance sheet of the company. How many businesses are included in that entity? How many entities do we have? Where are those businesses doing business? And I'd start to think about, again, if most business owners are thinking they're going to get a capital gains exemption, I'd start thinking about, is there excess cash in my business or is there excess value outside of Canada? And that's where I would start. I would start with the minute book. I would then do okay, what's my balance sheet look like on a fair market value basis? And where are those businesses being conducted? And then just do some math and spreadsheet work and phone your friendly neighborhood tax advisor. Because the best thing is probably just having a good discussion. And see where that discussion goes. If you're not talking about it, nothing's going to happen.
So in all the years that you've helped people and dealt with transactions, which one brought you the closest to tears because they just did not have good advice or structured themselves well, and what's been left on the table or handed to the government through taxes broke your heart?
I would say the structure that was the holdco opco. And running a successful business, trapping a bunch of money in the holding company, and business owner was doing great, but they couldn't get their exemption. The other heartbreaker that does come to mind is also their governance was so atrocious that the purchaser walked away. They just did not have their house in order. And although they had a good business, they just, the due diligence process fell apart. And so solid business, but they had too many governance issues for a purchaser to take confidence that what else do I not know?
And that's a beautiful soft plug for a lot of the work we do at Amplify, because so often we're working with growing businesses, not exiting businesses, but oftentimes even the due diligence of investors or bankers, it's that messy back of the house and that messy accounting that stops them from being able to take the next step in their growth. And so I can just imagine after a lifetime of it, and you're actually trying to get out, how that would just accumulate and become even more impactful. So I love that. The other question that I wanted to ask you, I think most of our attendees do actually know this, but I never like to base anything off assumptions. And I feel that you and I have been guilty of this. Can you just talk a little bit about the difference between a sale that is a sale of shares and a sale of assets, and how that can be impactful? Because again, feel like we've done the presentation assuming everyone understands that difference, but that's not necessarily a fair assumption. And for those of us that do understand it, I don't think it would hurt for us to hear it in your voice one more time.
Sure. So if we just think about a corporate entity, so let's think about the box. If I'm selling stuff that's inside the box, that's a sale of assets. And that's likely going to trigger much more complications. And a purchaser, has to do more due diligence, because I don't know if I'm getting all my contracts that are within the box. A sale of shares is basically selling the assets that are held outside the box, i.e. share certificates. And that means that everything that's inside that box goes to the purchaser. So typically there's due diligence, but at least the purchaser knows that they're going to get everything related to that business. So again, when you're selling shares, you're usually selling a long-term capital property, and more likely than not, you're going to have a capital gain. Unfortunately, when you sell assets, just because of the tax rules, you're not automatically going to get a capital gain. There could be some income that arises on account of income, some that's going to be capital. But again, that's the corporate's money, not yours. So now once the assets have been sold, you got to figure out, how do I get that money into my personal hands? And there's another level of tax. And so when you're saying, oh, I'm going to get a much higher price for my asset sale, I'm going to go that way. Well, unfortunately, that's the corporation's cash. So once you go through the calculations and you figure out how much is going to be in your pocket, which was what would happen on a share sale, those two numbers could be a completely different story.
So by and large, what we see, and what I hear you also see, that an asset sale might make your business valuation higher, and a share sale could very likely make it lower. But then once you take the tax consideration into account as the seller, you would have generally have a bias towards a share sale, which also is not only is there the capital gains exemption to consider, but there's also the liability that go along with the shares, and that you're free and clear and moving to your next business, as all serial entrepreneurs do.
That's right. And I guess I'll say, as a rule of thumb, purchasers want to buy assets, sellers want to sell shares.
Yeah. And that is reflected in the price.
And there's even structures that we can implement that everyone can have their cake and eat it too. You can do what's called a hybrid, again, a little bit more specialized depending on the fact situation. But at the end of the day, if you talk about this sooner rather than later, because the last thing you want to do on a sales transaction is to bring up, hey, here's some tax planning I want to do before close, and close is 2 weeks away. The purchaser will let you do it, and here's the discount to the purchase price to allow you to save your tax. So plan early, don't allow it to come off the top of your sales proceeds.
Awesome. So we're at the 80-minute mark. I'm going to make Nikki's life easy for her CPD certificates that she has to write up, and cut us off at the 80-minute mark. That was really, really useful. I really appreciate you coming, and I hope that people don't hesitate to reach out to you. We'll be sharing a PDF of the information that we covered today. I know it was a lot, so really happy to share that and continue the conversation. Just to recap some of the admin items, we have Lively Entrepreneur Talks with Amplify, which is Jesse and I talking about hot topics in business. Let's with Amplify, the first episode was cash flow, talking about how cash flow challenges come with growth. And today's episode that just launched today is on talent, and it's everything to consider when hiring and leading teams, which is obviously critical to all of us as business leaders. AHA, which is our every third Tuesday webinar series that you're attending right now, as well as live events. The next one is April 18th. We're really excited to talk about business liability exposures and risk management tips. So we have one of our favorite insurance people coming to go through that with us. May 16th, we've got our internal Amplify tech team. We're going to talk about technology trends and ERPs and cloud systems and all those things that are obviously hot topics for today's world. And in June, we're going to touch on personal branding and how critical that could be for people's career, both within the organizations that they're happy in and within their hiring and new journeys as well. So that will wrap up the AHA season. We take July and August off. In September, we're coming back with supply chain as our first webinar on the third Tuesday in September. So very, very thankful to all of you that regularly attend and give us feedback. Please do let us know how we're doing. We're really trying to support our network of business leaders and CPAs, and we love the opportunity to do so. So thanks again, and have a wonderful Tuesday afternoon. Thank you, Rick.
Thank you so much. Glad to be here.
Awesome. Thank you.
And you can call me. I enjoy coffee, so we'll do another one.
Oh, yes, let's do that. I enjoy coffee as well, and wine and beer.
All right. Take care, everybody.
Beverages are my favorite thing.